There are three charts that tell you everything you need to know about what's coming. Three pieces of data that have predicted every major market collapse for the last century. And right now, in December 2025, all three are flashing the same warning they flashed in 1929, in 2000, and in 2007. But here's what you need to understand. Wall Street doesn't want you looking at these charts. Not because they're secret. They're completely public. Anyone can access them. The data is published monthly, tracked by government agencies, verified by institutions. But Wall Street buries them. They don't discuss them on CNBC. They don't feature them in quarterly presentations. They don't explain them to retail investors. Because if regular people understood what these charts were saying, they wouldn't be buying at these levels. They'd be running for the exits. The first chart measures total market value against economic output. The second measures long-term earnings against current prices. The third measures leverage, how much investors are borrowing to buy stocks. And when you understand what these three charts are telling you right now, you'll see that we're not in a normal market. We're in the final stage of a bubble, the same stage that preceded the Great Depression crash, the dot-com crash, and the 2008 financial crisis. This isn't doom-mongering, this isn't prediction, this is pattern recognition. Because markets don't crash randomly. They crash when specific conditions align. Extreme valuations, stretched earnings multiples, and excessive leverage. And those conditions exist right now, not similar conditions. Identical conditions to every major crash in modern history. Let me show you exactly what these three charts reveal. Why Wall Street doesn't want you seeing them, what happened the last three times they looked like this, and what you need to understand before the pattern completes. Because once you see these charts, you can't unsee them. And you'll understand why the smart money has been quietly repositioning for months while telling the public everything is fine. Chart 1, the Buffett Indicator, market cap to GDP. Let's start with the chart. Warren Buffett called probably the best single measure of where valuations stand at any given moment. It's simple. Take the total value of all publicly traded stocks in America. Divide it by the gross domestic product. The result tells you whether the market is expensive, cheap, or somewhere in between. Here's how Buffett explained it in a Fortune magazine interview back in 2001. If the percentage relationship falls to the 70% or 80% area, buying stocks is likely to work very well for you. If the ratio approaches 200%, as it did in 1999 and part of 2000, you are playing with fire. That was Buffett's warning 24 years ago. The ratio hit 200%. Stocks were dangerously overvalued. And what happened next? The dot-com crash. The NASDAQ fell 78% over the next 2 years. Trillions in wealth evaporated. Companies went bankrupt. Retirement accounts got cut in half. So where are we now? As of December 2025, the Buffett Indicator sits at approximately 222%, not 200%. Not the danger zone Buffett warned about, higher. The highest level ever recorded in American history. Let me put that in perspective. The total market capitalization of all U.S. stocks is $56 trillion. The GDP of the United States is roughly $25 trillion. That means the stock market is valued at more than double the size of the entire economy. Stocks are worth more than twice the annual output of every worker, every business, every service in America. Think about what that means. The market is priced as if it will generate returns far exceeding what the real economy can produce. It assumes unlimited growth, unlimited profits, unlimited expansion. And history shows that whenever valuations stretch this far beyond economic reality, the correction is brutal. The Buffett Indicator has warned of danger twice before in modern history. In 1999, it hit approximately 159% using the older calculation method. Buffett warned publicly. He said stocks were overvalued. Nobody listened. The NASDAQ crashed 78%. The S&P 500 fell 49%. It took 7 years for the market to recover those losses. In 2007, the indicator hit around 105% using older metrics, which was extreme for that era. Again, stocks crashed. The S&P fell 57% from October 2007 to March 2009. Banks failed. The housing market collapsed. The global financial system nearly imploded. And now in 2025, we're at 2%, higher than the dot-com bubble, higher than the 2008 peak, higher than any point in recorded history. The only other time we briefly approached this level was during the COVID stimulus frenzy in 2021, when the government printed trillions and valuations spiked temporarily before pulling back. But here's what Wall Street won't tell you. They'll say this time is different. They'll point to technology, artificial intelligence, productivity gains, global markets, innovation. They'll argue that higher valuations are justified because companies are more profitable, more efficient, more global than ever before. This is the same argument they made in 1929. Stocks have reached a permanently high plateau. The economy has entered a new era. Valuations are justified by modern productivity. Then the market fell 89%. It's the same argument in 1999. The internet changes everything. Traditional valuation metrics don't apply. We're in a new paradigm. Then the NASDAQ fell 78%. It's the same argument in 2007. Housing prices never fall nationally. Complex financial instruments have distributed risk. The system is safer than ever. Then the market fell 57% and the global economy nearly collapsed. The pattern is always the same. Extreme valuations appear. Experts justify them with new era logic. The public believes it, and then reality reasserts itself. Markets revert to historical norms, and the people who bought at the top lose everything. Now, let's be clear about what the Buffett Indicator does and doesn't tell you. It doesn't predict timing. It can't tell you whether the crash comes in 1 month, 6 months, or 2 years. Markets can stay overvalued longer than seems rational. The dot-com bubble lasted months beyond when valuations screamed danger. The 2008 bubble persisted through most of 2007, despite warning signs. What the Buffett Indicator tells you is this. At current levels, future returns will be poor. If you buy stocks when the ratio is at 222%, historical data shows your returns over the next 10 years will likely be negative or minimal because valuations this high eventually revert to the mean, and mean reversion means stocks must fall significantly from current prices. The historical average for the Buffett Indicator is around 80%. That's the normal range over decades. Currently, we're at 222%. To return to the historical average, stocks would need to fall approximately 64%. That doesn't mean they will fall 64% tomorrow. It means that at some point, whether through a crash or years of stagnation, valuations will normalize. And normalization from these levels means significant losses for anyone buying at the top. Here's the math. If you invest $100,000 in stocks when the Buffett Indicator is at 222%, Wall Street doesn't show you this chart because if you understood it, you'd stop buying. You'd realize that at these valuations, you're not investing. You're speculating that valuations will stretch even further beyond historical norms. You're betting that this time really is different. And history shows that bet loses catastrophically. But the Buffett Indicator alone isn't enough, because valuations can remain elevated if earnings are strong. If companies are generating massive profits, high valuations might be justified. That's where the second chart comes in. Chart 2, the Shiller PE Ratio, the CAPE. The Shiller PE Ratio, also called CAPE, which stands for Cyclically Adjusted Price to Earnings, was developed by Yale economist Robert Shiller. He won the Nobel Prize in economics partly for this work. And the reason this metric matters is because it solves a problem with traditional valuation measures. Normal PE ratios use a single year of earnings, but earnings fluctuate wildly year to year. During recessions, profits collapse and PE ratios spike, making stocks look expensive when they're actually cheap. During booms, profits surge and PE ratios fall, making stocks look cheap when they are expensive. Shiller's solution was simple but powerful. Instead of using 1 year of earnings, use 10 years. Take the average inflation-adjusted earnings over the past decade and divide current stock prices by that average. This smooths out business cycle fluctuations and gives you a clearer picture of whether stocks are genuinely expensive or cheap. The historical average for the Shiller PE is around 17. That's the normal range over more than 140 years of data going back to 1881. Below 12 is cheap, above 25 is expensive, above 30 is bubble territory, above 40 is extreme danger. As of December 2025, the Shiller PE ratio stands at approximately 40. We're in extreme danger territory. Only twice in American history has this metric been higher. The first time was 1929. The Shiller PE hit around 33 just before the crash that triggered the Great Depression. Stocks fell 89% over 3 years. The second time was during the dot-com bubble in late 1999 and early 2000. The Shiller PE peaked at 44, the highest level ever recorded. What happened next? The NASDAQ crashed 78%. The S&P fell 49%. $5 trillion in market value evaporated. Right now we're at 40, the second highest reading in 144 years of data. The only period more overvalued was the dot-com peak, and we all know how that ended. Let me explain what a Shiller PE of 40 means in practical terms. It means investors are paying $40 for every dollar of average inflation-adjusted earnings over the past decade. That's nearly 2.5 times the historical average of 17. Stocks are priced as if earnings will grow dramatically from here. But the 10-year average already includes the boom years. It includes the AI hype. It includes record corporate profits. And even with all that baked in, valuations are extreme. Here's why this matters. High Shiller PE ratios reliably predict poor future returns. Shiller and other researchers have studied this relationship for decades. The data is overwhelming. When you buy stocks at a Shiller PE above 30, your average annual return over the next 10 years is typically 1% to 3% per year, often negative after inflation. When you buy at a Shiller PE above 40, history shows returns are worse. The dot-com buyers who purchased near the 2000 peak saw negative returns for 7 years. The 2007 buyers near a Shiller PE of 27 saw negative returns for 5 years. Current buyers at 40 face similar prospects. But Wall Street won't show you this chart during bull markets. They'll show you trailing 12-month PE ratios, which look more reasonable at around 29. They'll tell you earnings are strong, growth is solid, the future is bright. What they won't mention is that earnings are cyclical. They peak during expansions and crash during recessions. And buying at peak earnings is how you lose money. The Shiller PE accounts for this. By averaging 10 years of earnings, it tells you whether current valuations are sustainable. And at 40, they're not. To return to the historical average of 17, stocks would need to fall 57% from current levels. That's not doom-mongering, that's mathematical mean reversion. Now, some analysts argue the Shiller PE is outdated. They say accounting rules changed in the 1990s, making modern earnings look lower than they really are. They claim technology and globalization justify higher valuations. They insist that interest rates being lower than historical norms means stocks should trade at higher multiples. These arguments have merit at the margins. Maybe the fair value Shiller PE isn't 17 anymore. Maybe it's 20 or 22 to account for structural changes. But even if we're generous and say fair value is 25, we're still at 40. That's 60% above fair value, even using the most optimistic assumptions. History is clear on what happens next. In October 2021, the Shiller PE hit 38. Over the next 12 months, the S&P 500 fell 22%. In late 1999, it hit 44. Over the next 3 years, the market fell 49%. In 1929, it hit 33. Over the next 3 years, stocks fell 89%. We're at 40 right now, and the pattern is repeating. But there's a third chart that makes the situation even more dangerous, because it's not just that stocks are overvalued, it's that investors are borrowing massive amounts of money to buy these overvalued stocks. And that's when crashes turn into collapses. Chart 3, margin debt, the leverage indicator. Margin debt is money investors borrow from brokers to buy stocks. When you're bullish, you borrow. When you're bearish, you pay back those loans. It's a pure measure of investor confidence and risk appetite. And it's one of the most reliable early warning signs of market tops. Here's why margin debt matters. When markets are rising, investors get greedy. They want to buy more than they can afford, so they borrow against their existing holdings. This works beautifully in a bull market. If you borrow $50,000 and use it to buy stocks that rise 20%, you made $10,000 on borrowed money. But if those stocks fall 20%, you lose $10,000 on borrowed money. And if they fall 30% or 40%, you face margin calls. Your broker forces you to sell to cover the loan. This creates cascading failures. When stocks fall, leveraged investors get margin calls. They're forced to sell. Their selling pushes prices lower. That triggers more margin calls, more forced selling. Prices fall further. It becomes a self-reinforcing panic. This is what happened in 1929, in 2000, in 2008, and it's what happens in every crash. As of November 2025, total U.S. margin debt stands at approximately $1,024 trillion. That's the highest level ever recorded. Higher than the 2000 peak, higher than the 2007 peak, higher than the brief 2021 spike. We are at all-time record leverage heading into 2026. Let me put that number in context. In 1999, before the dot-com crash, margin debt peaked at around $280 billion adjusted for inflation. In 2007, before the financial crisis, it peaked at approximately $380 billion adjusted. Both times, the peak in margin debt preceded the peak in stock prices by a few months, and both times, when stocks turned, the deleveraging was catastrophic. Today, we're at $1.24 trillion. That's roughly 3 times higher than the 2007 peak, even after adjusting for inflation and market size. Investors have never been more leveraged, never borrowed more money to buy stocks. And that means when the turn comes, the forced selling will be unprecedented. But it's not just the absolute level that matters. It's the relationship between margin debt and the total market. According to data from FINRA, the increase in margin debt over the past 12 months was approximately 0.35% of the total U.S. stock market value. That's about 0.89 standard deviations above the historical average. What makes this particularly dangerous is the credit balance. This is a measure that subtracts margin debt from the total cash investors have in brokerage accounts. When the credit balance is positive, it means investors have more cash than debt. That's conservative. When it's negative, it means investors owe more than they have. That's risky. As of November 2025, the credit balance is negative $817 billion. That's the most negative reading in history. Worse than 2000, worse than 2007, worse than 2021. Investors are collectively underwater. They owe more to brokers than they have in cash. This has never happened before to this degree. Think about what this means. Investors are so confident the market will keep rising that they've borrowed record amounts. They're not just fully invested, they're leveraged beyond their capital. This works only if prices continue rising. The moment they fall, margin calls trigger automatic selling. And with $124 trillion in borrowed money, the forced liquidation will be massive. History shows exactly how this plays out. Let me walk through the three most recent examples. In 2000, margin debt peaked in March at around $280 billion adjusted. The Nasdaq peaked the same month. As stocks began falling, margin calls forced selling. The selling accelerated the decline. By October 2002, margin debt had collapsed to $120 billion. That's a 57% decline. And during that same period, the Nasdaq fell 78%. The pattern is clear. Peak margin debt coincides with peak stock prices. Then both fall together. The leveraged investors who borrowed to buy at the top are forced to sell at the bottom. They lose not just their initial investment, but the borrowed money too. In 2007, margin debt peaked in July at approximately $380 billion adjusted. The S&P 500 peaked 3 months later in October. As the financial crisis unfolded, margin calls cascaded. By February 2009, margin debt had fallen to $170 billion, a 55% decline. During that same period, the S&P fell 57%. Again, peak leverage preceded the peak in prices by a few months. And once the selling started, leverage amplified the decline. Investors who borrowed to buy homes and stocks lost everything. In 2021, margin debt briefly spiked to nearly $950 billion during the COVID stimulus mania. The S&P peaked in December 2021. Over the next year, stocks fell 22% and margin debt declined. But that drawdown was mild compared to 2000 and 2008. The Federal Reserve intervened quickly with supportive policy language, and the market stabilized before a full crash developed. Now we're in 2025. Heading into 2026, margin debt is at $124 trillion. That's 30% higher than the 2021 peak. And the credit balance is the most negative in history. This is the setup for a crash, not a correction. What makes it worse is where the leverage is concentrated. According to data, much of the recent margin debt increase has gone into the largest technology stocks, the same Magnificent Seven stocks that dominate the S&P 500. NVIDIA, Apple, Microsoft, Amazon, Meta, Alphabet, Tesla. These 7 companies account for approximately 35% of the index. And they're the stocks retail investors are borrowing money to buy. This concentration creates a dangerous feedback loop. When investors borrow to buy the largest stocks, those stocks rise. Their rise increases the total market cap. The Buffett Indicator climbs higher. The Shiller PE rises further. Valuations become more extreme. But investors see rising prices and feel validated, so they borrow more. The cycle continues until something breaks. And what breaks is confidence. It doesn't take a crisis. It doesn't require a recession. All it takes is for prices to stop rising. Because once leveraged investors stop making money, they stop borrowing. And once they stop borrowing, the fuel for further gains disappears. Prices stall, then they fall. Margin calls trigger, selling accelerates, and the whole structure collapses. Wall Street doesn't show you the margin debt chart during bull markets. They talk about strong investor sentiment, robust participation, healthy market breadth. What they don't mention is that high margin debt is the hallmark of tops, not bottoms. Investors borrow most at the worst possible time, right before crashes. Now let's step back and look at all 3 charts together. Because individually, each one is concerning. Together, they paint an undeniable picture. Chart 1, the Buffett Indicator, is at 222%, the highest level in history. Stocks are more expensive relative to GDP than ever before. Chart 2, the Shiller PE Ratio, is at 40, the second highest level in 144 years of data. Only the dot-com bubble was more overvalued. Chart 3, margin debt, is at $124 trillion with a credit balance of negative $817 billion. Investors are more leveraged than any point in history. These aren't predictions. These aren't opinions. These are facts. Publicly available data published by government agencies, exchanges, and academic institutions. And the data is screaming the same warning it screamed 3 times before. In 1929, all 3 indicators were extreme. High valuations, stretched earnings multiples, excessive leverage. The market crashed 89%. In 2000, all 3 were extreme. The market fell 78% on the Nasdaq, 49% on the S&P. In 2007, all 3 were elevated, though not as extreme as today. The market fell 57%. Right now, all 3 are at or near all-time extremes. The setup is worse than 2000, worse than 2007, arguably worse than 1929 when adjusted for market size and modern leverage tools. What happens when all 3 conditions align? History shows the sequence. First, valuations peak. Stocks reach levels that can't be sustained by underlying earnings or economic growth. This is where we are now. Second, momentum stalls. Prices stop rising. The investors who borrowed money to chase gains start breaking even or losing money. Confidence wavers, new buying slows. Third, something triggers selling. It could be anything. An earnings miss, a geopolitical shock, a policy mistake, an unexpected bankruptcy. The trigger doesn't matter. The system is fragile. Any shock can start the cascade. Fourth, margin calls. Begin, leveraged investors are forced to sell. Their selling pushes prices lower. More investors hit their margin limits, more forced selling. The feedback loop accelerates. Fifth, panic sets in. What started as profit-taking becomes selling to avoid losses. Then selling to meet margin calls. Then selling in panic. Volume spikes. Volatility explodes. Circuit breakers trigger. Trading halts. Fear spreads. Sixth, the crash completes. Prices fall until valuations reach reasonable levels. The Buffett Indicator returns toward 80% to 100%. The Shiller PE falls toward 15 to 20. Margin debt collapses as investors deleverage. This process can take weeks, months, or years, depending on the severity. Finally, recovery begins, but not for years. The 2000 crash took 7 years to recover. The 2008 crash took 5 years. The 1929 crash took 25 years. The people who bought at the top lost decades of returns. This is the pattern. And right now, we're in stage 1, valuations at unsustainable peaks. The question isn't whether a crash is coming. History says it is. The question is when, and what triggers it. Let's be direct about why these 3 charts don't appear in your broker's quarterly reports or CNBC's market coverage. It's not conspiracy, it's incentive structures. Wall Street makes money when you trade. Brokers earn commissions, investment banks earn fees, fund managers collect assets under management. All of these revenue streams depend on investors buying stocks. If investors understood that valuations are at historic extremes, that earnings multiples are unsustainable, and that leverage is at dangerous levels, they'd stop buying. They might even start selling. That would be catastrophic for Wall Street's business model. So instead of showing you the Buffett Indicator at 2 and 22%, they show you trailing PE ratios that look more reasonable. Instead of discussing the Shiller PE at 40, they focus on forward earnings estimates that assume continued growth. Instead of highlighting margin debt at all-time highs, they talk about strong investor sentiment and market participation. This isn't lying. It's selective presentation. They're not making up numbers. They're choosing which numbers to emphasize. And they emphasize the ones that make stocks look attractive because that's what keeps money flowing into the market. Another reason Wall Street avoids these charts is timing uncertainty. The Buffett Indicator doesn't tell you when stocks will fall. It tells you they're overvalued. The Shiller PE doesn't predict crashes. It predicts poor long-term returns. Margin debt shows excessive leverage, but leverage can persist for months or years. So Wall Street can plausibly claim these indicators don't matter for short-term trading. And they're right. If you're a day trader or a short-term speculator, valuations don't matter. Momentum matters. But for long-term investors, these 3 charts are everything. They tell you whether you're buying value or buying a bubble. The final reason is that crashes hurt everyone. When the market falls 50%, it's not just retail investors who lose. Institutions lose, pension funds lose, hedge funds lose, banks lose. The entire financial system suffers. So there's a collective interest in maintaining confidence, in avoiding panic, in keeping the game going as long as possible. This is why you won't see these charts on CNBC, why your financial advisor probably hasn't mentioned them, why quarterly market commentary focuses on earnings growth and economic indicators instead of valuation extremes. Because once you see these charts, once you understand what they mean, you can't unhear the warning. And the warning is clear. We are late-stage bubble, the longest, most expensive, most leveraged bubble in American history. And late-stage bubbles always end the same way. Let's be precise about what historical patterns suggest without making predictions. Because I can't tell you the future. No one can. But patterns exist, and those patterns have repeated with remarkable consistency. When the Buffett Indicator exceeds 200%, subsequent 10-year returns are typically near zero or negative. We're at 222%. Historically, that suggests the next decade of stock returns will be poor. Not a crash next month necessarily, but poor returns over time as valuations revert. When the Shiller PE exceeds 35, markets tend to experience significant drawdowns within 1 to 3 years. We're at 40. Previous times it reached this level were 1929 and 2000, both followed by devastating crashes. The timing varied, but the outcome was consistent. When margin debt reaches all-time highs while credit balances turn deeply negative, corrections tend to be severe. We're at $1,024 trillion in debt with negative $817 billion in credit. The last 3 times margin peaked, stocks fell between 22% and 78%. Combining all three indicators, what does history suggest? That we're in the final innings of a bubble. Not the beginning, not the middle, the final stage where valuations are so extreme that even modest catalysts can trigger rapid repricing. The timeline is uncertain. The dot-com bubble persisted for months after valuations screamed danger. The 2008 bubble lasted through most of 2007, despite warning signs. Markets can remain irrational longer than seems possible, but they don't remain irrational forever. Eventually, math reasserts itself. Mean reversion occurs, and those caught at the top suffer losses that take years or decades to recover. Based on historical precedent, a reasonable interpretation would be that sometime in the next 12 to 24 months, stocks will experience a significant correction or crash. The magnitude could range from 30% to 60% depending on how quickly deleveraging occurs and how long valuations take to normalize. That doesn't mean you should panic. It doesn't mean selling everything tomorrow. It means understanding the risks, recognizing that at these valuations, the risk-reward is terrible. Potential upside is maybe 10% to 20% if the bubble extends further. Potential downside is 40% to 60% when reversion occurs. That's not a trade any rational person should take with money they can't afford to lose. Here's what most people don't want to hear. If you're invested in stocks right now, you're either early to a crash or late to a bubble. There's no middle ground at these valuations. If you bought stocks 5 years ago, you've done well. Congratulations. The run from 2020 to 2025 has been extraordinary. But that's in the past. The question is whether you hold from here. And these three charts say holding is dangerous. If you're buying stocks now, in late 2025 or early 2026, you're buying at valuations higher than 99% of history. You're betting that this time is different, that somehow valuations will remain at 222% of GDP indefinitely, that earnings multiples of 40 times 10-year averages are sustainable, that record leverage won't trigger forced selling when prices fall. Maybe you're right. Maybe technology and AI really do justify these valuations. Maybe interest rates staying lower than historical norms support higher multiples. Maybe this time is different. But every bubble in history thought it was different, and every bubble was wrong. The pattern doesn't fail. Extreme valuations eventually revert. Excessive leverage eventually deleverages. And the people at the top, when reversion occurs, lose catastrophically. The mathematical reality is simple. To return from a 222% Buffett Indicator to the historical average of 80% requires a 64% decline in stock prices. To return from a Shiller PE of 40 to the historical average of 17 requires a 57% decline. These aren't predictions of doom. They're descriptions of mean reversion. Maybe the reversion happens through a crash over 6 months. Maybe it happens through stagnation over 10 years. But it happens. It always has. And those who understand this protect themselves. Those who don't learn an expensive lesson. What this means for you, I'm not going to tell you what to do. That's your decision based on your situation, your risk tolerance, your timeline. But I will tell you what these three charts suggest about the current environment. Stocks are more expensive relative to economic output than any time in recorded history. Earnings multiples are higher than any time except the dot-com peak. Leverage is at all-time highs with record negative credit balances. This is a dangerous combination. For long-term investors, this suggests caution, reducing equity exposure, raising cash, diversifying into assets that aren't at historic valuation extremes, being prepared for volatility, having a plan for what you'll do if stocks fall 30%, 40%, 50%. For those in or near retirement, this is particularly critical. If you're 60 years old with $1 million in stocks and the market falls 50%, for younger investors, the calculus is different. If you're 30 years old with decades ahead, a crash might be an opportunity. You can buy stocks at 50% off and compound from lower valuations, but that only works if you have cash to deploy. If you're fully invested at the top, you participate in the losses without capital to benefit from the recovery. The key insight these three charts provide is this. Risk is not priced. The market is priced for perfection, for continued growth, for expanding multiples, for infinite liquidity. Any deviation from perfection triggers repricing. And repricing from these levels means substantial losses. You can't time markets perfectly. Nobody can. But you can recognize when risk-reward is favorable and when it's terrible. And these three charts make clear that right now, in late 2025, risk-reward is terrible. The potential for further gains is limited. The potential for steep losses is high. Let me end with this. The reason these three charts matter is because the pattern has never failed. Not once in 150 years of data. When stocks trade at more than twice GDP, future returns are poor. When earnings multiples exceed 35, crashes follow. When leverage reaches extremes, deleveraging triggers, panic. This has happened in 1929, in 2000, 2007, and it's happening now. Wall Street won't show you these charts because they reveal what's coming. They can't hide the data, but they can avoid discussing it. They can focus on other metrics. They can emphasize short-term momentum. They can argue this time is different. But the charts don't lie. The pattern doesn't change. History doesn't repeat exactly, but it rhymes. And right now it's rhyming with 1929, with 2000, with 2007. The same conditions, the same warnings, the same willful blindness by the majority who want to believe the party will continue forever. It won't. It never does. Extreme valuations revert. Excessive leverage deleverages. Bubbles pop. This is the most reliable pattern in financial markets, and we're watching it play out in real time. The Buffett Indicator at 22%, the Shiller PE at 40, margin debt at $1.24 trillion with negative credit balances. 3 charts, 3 warnings, all saying the same thing. This is late-stage bubble, and late-stage bubbles always end the same way, not with triumph, with tears. The only question is whether you are positioned to weather what's coming, or whether you'll be one of the people learning about these 3 charts too late. If this documentary showed you something you didn't know, if you understand now why these 3 charts matter, then you have a choice. You can ignore the pattern and hope this time is different. Or you can recognize what history teaches and position accordingly. The charts are public. The data is clear. The pattern has never failed. What you do with that information will determine whether you survive the next collapse or become another casualty of it. The setup is complete. The warning is clear. The only thing uncertain is timing. But timing doesn't change the outcome. It only changes whether you're ready when it arrives.